Starting a small business is exciting. You have an idea, energy, and the motivation to build something meaningful. But many businesses do not fail because of competition or bad products. They fail because of financial mistakes that happen quietly in the background. In this video, you will learn 5 financial mistakes that quietly destroy small businesses. The first mistake is ignoring cash flow management. Many business owners focus on revenue and sales numbers. They think that if the business is making money, everything is fine. But revenue and cash flow are not the same thing. A business might show strong sales on paper while still running out of cash. This usually happens when customers pay late, expenses come earlier than expected, or inventory ties up too much money. Without enough cash available, even profitable businesses can struggle to pay rent, payroll, or suppliers. Managing cash flow carefully is one of the most important responsibilities of any business owner. The second mistake is mixing personal and business finances. This is very common in small businesses, especially during the early stages. Owners often use the same bank account for both personal expenses and business transactions. At first, it feels convenient, but it creates confusion. When finances are mixed, it becomes difficult to track real business performance. Tax reporting becomes messy, budgeting becomes inaccurate, and financial decisions become unclear. Separating business accounts from personal accounts creates transparency and helps owners understand exactly how the business is performing. The third mistake is not tracking financial data regularly. Many entrepreneurs are focused on operations, sales, marketing, and customer service. Because of this, they only check financial numbers occasionally. Sometimes they only review the numbers during tax season. This approach can hide problems for months. Expenses might slowly increase, profit margins might shrink, or certain products might become unprofitable. Without regular financial tracking, business owners lose visibility into what is actually happening inside the company. Reviewing financial reports monthly helps identify issues early and allows smarter decision-making. The fourth mistake is growing too fast without financial planning. Growth sounds like a positive thing, but rapid expansion can create financial pressure. Hiring employees, buying equipment, increasing inventory, or opening new locations all require capital. If growth is not supported by proper financial planning, the business may take on too much debt or run out of working capital. Healthy growth should be supported by clear forecasts, stable cash flow, and realistic budgeting. The fifth mistake is ignoring financial reserves and emergency funds. Every business faces unexpected situations. Equipment breaks down, sales decline temporarily, or large clients delay payments. Without financial reserves, these situations can become crises. An emergency fund acts as a financial safety net. It allows the business to survive difficult periods without panic decisions, such as high-interest loans or cutting essential operations. Running a successful small business requires more than just a good idea. It requires financial awareness, discipline, and consistent monitoring.